Hello guys. During the trading week of January 12th to 16th, 2026, I presented several tape reading sessions analyzing cables price action across the London Open, New York Open, and London close kill zones. Our live focus were primarily on Tuesday, January 13th and Wednesday, January 14th. In this video, I'll be outlining the exact model behind those sessions and walk you through a day-to-day backtest of that model across the entire trading week to evaluate its consistency. Let's dive in. Backtesting is a process of applying a trading strategy to historical price data to see how it would have performed in the past. It doesn't guarantee future profits though, but it does help us eliminate bad strategies before we risk real capital, and that alone can save you years of frustration. We'll be using ICT's principles. ICT is the inner circle trader. You can find his videos here on YouTube by searching for the inner circle trader. The concepts we'll be using will primarily be based on the 4-hourly chart and the 15-minute charts. We would use the 4-hourly charts to frame our directional bias and use the 15-minute chart to frame our entry, define our risk, and also our reward. The model we are using works on the ICT principles that states that price moves from an area of internal range liquidity to external range liquidity and vice versa. That is to say that if at the beginning of the trading day, price has taken an area of external range liquidity, we should expect a draw towards internal range liquidity, and that would form our bias for the day or for that session. On the other hand, if price has traded to an area of internal range liquidity at the beginning of the trading day, we expect that it should draw towards external range liquidity, and the location of that external range liquidity, be it in discount or premium, will determine our directional bias for the day. As you can see on my screen, this is the 4-hourly cable chart. I'm going to go back to the beginning of the trading week, which is the 12th of January 2026. So we begin. By the formation of this 4-hourly candle, you will notice that price has taken an area of external range liquidity, which is this buy side liquidity located right here. The principle is for price to move from internal range to external range and vice versa. When we look at this price action, you'd notice that price has taken an area of buy side liquidity, which would mean that we should expect for price to move to internal range. There is this fair value gap between this candle's high and this next candle's low. This candle's low is at 1.34158 and this bearish candle's high is at 1.34145. so there is a visible gap over there. However, we would notice that this 4-hourly candlestick closed above the area of buy side liquidity, which indicates price has shifted structure. Therefore, rather than looking for price to trade down to this area of internal range liquidity, we would expect that this area of buy side should be used to push price further up. I would scroll down to the 15 minutes time frame and frame a setup from there. Coming down to the 15 minutes chart, you would notice that this is a bullish breaker block, which corresponds with a 4-hourly old high we saw. We are then going to frame our setup around this area. When we move to the right, we notice that it also corresponds to a bullish order block on the 15-minute chart, which is this bearish candlestick over here. This bearish candlestick opens at 1.34482 and has a low of 1.34451. What then we would do is to use the opening price for entry, and because this platform offers spread, we are going to set our entry at 1.3450 and set our stop loss at 1.34450, or to accommodate for spread, set it at 1.34440. I would use the platform's replay widgets. Then we would go back to the 4-hourly chart, look at the next area of liquidity, which is this internal range over here, the gap between this candle's low and this candle's high. I'll pull it up, and this is up to about 31 pips. I'll set that and go down to the 15-minute chart. Then we would see how price fared. From our model, we were able to generate 30 pips. We would go up to see a report of what happened. You notice here that we set a buy order at 1.34502 and it closed at 1.34812, which gave us 31 pips in profit. On the very next day, by the 8 o'clock candlestick here, you'd notice that price hadn't taken out any area of liquidity yet. There was this buy side here, which had been left untapped. Then there was also this internal range here, which had also been left untapped. I remember during the tape reading session, I was being careful because of core CPI news release that was to happen in the course of the day, and I mentioned the possibility of price either drawing down to this internal range before taking out the external range, or should it take out the external range, which is the buy side liquidity over here first. It was then going to draw down to this internal range over here, and we sat on the sidelines. We would notice that there is this bearish order block over here on the 4-hourly, where should price decide to take out the buy side liquidity first, we would expect that it should react around that area and then reverse to come to fill the gap here, or to be drawn towards the internal range that is at the discount position. I remember during the tape reading session, I mentioned that I really didn't want to trade during that day because this was the model I was looking for, and until I had seen it, I wasn't ready. We move down to the 15-minute chart, then go to the area of the 4-hourly bearish order block we identified. At this place, we notice that there is this bearish breaker block. So using the bearish candle, which closes at 1.34975, we could set a sell limit order over there, and our stop loss limit will be above the high of that bearish candlestick. The high comes in at 1.35031. What we are going to do is set a limit order 980 to round it up to the nearest whole number. Then I'll set the stop loss limit above here. Then we go down to the 4-hourly and expect price to draw towards this area of internal range liquidity. So I'm going to draw it just into it. This is about 52 pips. I'll take us back down to the 15-minute chart, and then we will take a look at how price fared. Let me pause. So you'll notice that the area I set actually, with the release of the core CPI news, price couldn't get to that level. And if you'd remember during the tape reading session, I told you I was still sitting on my hands because the level I expected price to draw to, it didn't get there. However, I still also explained that from the 1 minute change in structure, I could have picked a trade. However, because I was using this model, I didn't want to do anything contrary to what I was trying to teach. And you'd notice that price actually went lower into the take profit we set. The only thing that happened was price couldn't trigger because our entry level there, and which was our expectation, couldn't happen. We are following the model, and that's what we had to stick to. On Wednesday, by the 8 a.m. candle, we would notice that price had traded to an area of internal range liquidity. That meant that our expectation would be for price to draw down to external range right here. So at this level of the fair value gap high, I'll draw it out in price in time. At this level here, you'd notice that there is not one bearish candle that forms the bearish breaker block, but a series of consecutive candles. So we would use the Fibonacci retracement tool to find the midpoint of that area, and that comes in at 1.34621. What we then do is to set a limit order around that point. Then our stop loss will be above the high of the consecutive candlesticks. So, to allow for spread, we can set it at 10 pips away. We'd go to the 4-hourly chart and then set our stop loss limit, our take profit limit beneath this area of external range, which is about 45 pips away. I'll go down to the 15-minute chart, and then we would replay to see how price fared. Our entry point has triggered. and by this time we had entered into the next trading day and our profits just hit. And this happened on a Thursday. So the trade we entered in on Wednesday hits our profits on Thursday. Let's see the 4-hourly outlook by then. This is what happened. So it went way beyond what we projected to go. I'll do another video where I'll show you how you could have probably taken some profits off on the Wednesday and then entered in again on the Thursday to get beyond this level here. But 45 pips is just as good. By the 8 a.m. 4-hourly candle, price had traded into this area of internal range liquidity. And according to our model, from internal range, we expect price to come to external range, where then would be our targets below here. This is that area of external range. Inside this internal range liquidity, you can notice that there is this bearish breaker block here, which is made up of 2 consecutive bearish candles. We would draw that out in price because this is the biggest and most beefy candle. That should be the area we expect for price to draw to. We would draw that area out in price, scroll down to the 15-minute charts as we would always do, and look out for that 4-hourly bearish breaker blocks corresponding. Okay, when we come here, you'd notice that there are a series of consecutive bearish candlesticks. Then there is a bullish candlestick, then another series of consecutive bearish candlesticks. That lets us know that we would have to go up higher than the 15-minute chart to frame our entry. Because of the presence of this bullish candle in between these consecutive bearish candlesticks, the 15 minutes isn't appropriate for us to frame our entry. I'll then go up ahead to the 60-minute chart. Great, and we see only 2 consecutive bearish candles. So as we did before, we will use our fib retracement tool to measure the midpoint of these consecutive candlesticks, and this comes in at 1.34101. We will set our sell limit order at 1.34100. That is okay, we can get it to exactly 101. So let me leave it there and set our stop loss limit above the high of that candlestick, which is about 13 pips away. And then we would go up to the 4-hourly chart to indicate where we would take profit, which would be at this level here, and that is about 41 pips away. We would go down to the 15-minute chart, and then let's see the outlook. Okay, we've triggered. Price is still ranging around that entry price, and boom, there it is, 40 pips, and we've gotten it. So that will be it, guys. I've shown you the backtest strategy for the model we used this week. I hope you found this insightful. Until next time, cheers.